Manish, good morning. Thank you for joining us. Manish, some would say 5, some would say 10, I would say 15. That's about it. 15 stocks are taking the markets higher. How does one deal with a market like this where it's only Reliance or only TCS, someday it is HDFC and someday it is ICICI Bank and SBI. So whether it's 5, 10 or 15, but the definition of market outperformance is very limited. So as a fund manager, how are you dealing with this?
No, so but that statement is not entirely correct, because you have seen that the breadth of the market has also seen some improvement ever since the start of this calendar year. Last year was the mid caps, small caps were all over the place. The breadth of the markets was very poor. Of course, you still have those 12, 15 odd stocks leading the rally from the front, but suffice it to say that the broader markets have also participated to some extent. Of course, the extent of damage has not yet been fully taken out, but still there is some improvement.
The challenge, Manish, for most of the funds right now is that markets at an all-time high, the NAVs are not an all-time high. They're struggling to beat the benchmark. So do you think that markets or benchmark indices now will settle into a range and the market breadth will catch up, or you will be forced to look at the market differently?
No, it's entirely correct that you'll see a correction maybe, or maybe a stagnation in the headline indices, because they have run up quite a bit, and you'll see a catch up from the broader markets per se. And even the earnings support for FY20 is going to be there for the broader markets as well. So I would believe that since interest rates are not rising in a hurry, you'll see a catch up from the broader markets per se, rather than the headline indices rallying from the front. Of course, there's going to be a tailwind also from the frontline indices, but the extent of up move is going to be far sharper in the case of broader markets than maybe for the headline indices.
Okay, Manish, hi, morning. Want to talk about exactly the texture of the stagnation. Do you think corporate banks will continue to hold out? And what about the beaten down autos? Because one has seen some recovery in an iShare. Maruti has lifted off from those 65, 6,700 levels. Does it seem like things are now beginning to rebound? Tata Motors, global brokerages are saying that they assuage a 40% upside to Tata Motors. It's really with the star performer yesterday. Some follow through price action today as well. Are you willing to bet now on autos, and do you see a conclusive rebound in place for them?
So I think autos has a lot to do with liquidity conditions, and liquidity conditions are going to become somewhat better maybe a quarter or two down the line. So post Diwali, I think there should be a marked improvement in the auto space as a whole. Of course, you'll have to factor in the BS6 emission norm changes when it comes to pre-buying and what's going to happen post that in the CV space, in the two-wheeler space and the pass car space. From that perspective, I think that a lot of negatives are already there in the autos as a pack. There has been some significant valuation contraction. Of course, earnings are also going to degrow in this quarter as well as the next quarter. But autos is a very large space, and it cannot be ignored. If one was to build in a growth in the economy, you can't really ignore the autos for a very long time. So my sense is it's a catch-up game. Of course, there's also a possibility that GST rates might come down from 28% to 18% for the two-wheeler space. This will prevent the two-wheeler space and auto components catering to the two-wheeler space falling substantially from current levels. They will have some valuation cushion if this was to happen, and markets would want to build in some sort of positivity around this news flow that GST rates might come down from 28% to 18%, at least for the two-wheeler space.
We met last couple of times. I guess the template from your house was very clear. QGLP. Buy quality companies at a good price. Quality companies in this cycle are not available cheap. And you bought into iShare, Page, Bajaj Finance. These are good quality companies growing at good rate. Has your template changed? Have you changed anything in your top 3-4 holdings given how markets in last 6 months have been topsy-turvy?
Yeah, so QGLP remains the same. Of course, there is no compromise on philosophy and process at any given point in time. We will continue to buy quality. Of course, there's always a case of rebalancing the portfolio on an ongoing basis. So, of the names that you took, I mean, we have been selling, some of Bajaj Finance because we believe that valuations are very, very full, and slowly and gradually we're increasing exposure to corporate-facing banks, and I like ICICI Bank in that space. Of course, the thesis is that the corporate NPL cycle is somewhere close to peaking out, and the excess provisions that are being carried in an environment where IBC is functioning fully well, and you can see a lot of provisions written back over the next many years to come. And given that credit growth in the system should be around 15%, I would believe that valuations are comfortable at 1.7 times price to book. So it makes sense to sell something like a Bajaj Finance at 10 times price to book current year, which is fiscal 2019, and buy something which is maybe 1.7, 1.8 times price to book on an FY19 basis. So that's the trade we are playing out, but QGLP stays intact, and there is no compromise on that.
Manish, I see a fair few defensive plays as well in your notes. It says that that you do feel valuations are fair for some of the tech and pharma plays, and perhaps you're looking at a bit of a defensive mix there. Is that temporary? Do you see that changing perhaps based on what we see post elections, post any other near-term triggers? Because we are seeing some amount of potential in the broader markets. Again, from a couple of the earlier notes, you've talked about how perhaps there could be potential there in EPS growth. So would you perhaps change that mix and move away from defenses, or is that there to stay?
So we'll have a blend of beta and defensives in the portfolio per se, provided they qualify for the quality growth and longevity of growth. Of course, the thesis is that markets are likely to give a verdict on election results much before the election result counting date, and everything may be priced to perfection before 23rd of May, and maybe post that you are likely to see some correction. It's always that case of buying on rumor and selling on news. So the base case scenario will likely play out, and markets may continue to run up well beyond 12,000 in the run up to the counting date. But having said that, I think the IT and the pharma names are not just from a near-term perspective. I think the outlook on both these sectors, tech and the pharmaceutical space, continues to be quite good from the next 2 to 3 years perspective. In the technology space is digital led, and in the pharmaceutical space I think it's going to be volume led on the generic side, and more complex generics and specialty portfolios would tend to get better valued than the plain vanilla oral solid dosage formulations. So it's a pick and choose between these two sectors. Of course, there is no one size fit all rule that will apply to any of these two sectors. It's a bottom up approach. There will be selective names which will continue to do better than the rest of the pack, and I think we'll play it out accordingly, and we'll have both a mix of pharmaceutical and IT names along with economy facing sectors which will provide the beta to the portfolio.
Manish, any of these new listings or primary market offerings and niche ones in their space that you may be interested in? The recent one being Metropolis Healthcare. Some of the marquee names have also checked into that particular stock. And then, of course, today's listing, Polycab, wherein just the HNI segment itself has been subscribed just so many times.
Yeah, the conundrum is that one really doesn't get the required number of shares in these IPOs, and both Metropolis and Polycab are good listings. I think today's listings on Polycab also seems to be quite a decent issue. Depends on what price it gets listed, because to get your required quantity of stock in the portfolio, there could be a substantial premium to the listing price, because there was value left on the table as far as Polycab is concerned. I would not say so in the case of let's say Metropolis, which was priced well. We own Dr. Lal in that space, and if Metropolis was to gain, then obviously Dr. Lal would also stand to gain. It's the same business per se, just that different geographical regions. Dr. Lal catering to the NCR and Metropolis catering to the western part of India. But Polycab, I think, at 15, 16 times current year, or maybe 16, 17 times current year numbers, seems to be quite a decent play for a 20% plus ROC business. If you were to compare peer valuations in the form of Havels, I mean, it's a significant premium. I mean, just to give you some numbers, 8,000 crore turnover on the wire and cables, 50,000 crore market cap for Havels. Out here, 8,000 crore plus turnover on Polycab, valued at around 8,500 crores. So that's the dichotomy, and it makes sense to switch one for the other. But depending on what the free float is, whether stocks are really available at the price at which you want them. But nevertheless, there is value on the table in the case of Polycab.
Sure. The easy way out to buy financials is buy private banks. Very simple. Buy HDFC Limited, throw in an Axis Bank. Some may like IndusInd Bank, some may like both. That's a very easy way, and that's what everybody does. But then if you are looking at beating benchmark and looking at beating the industry, how exactly would you be approaching financials differently?
So obviously it is advantage banks over NBFCs. So reduction in NBFCs to the extent possible. And within the banking space, the conundrum is that the state-owned banks have the deposits. They don't have the capital, so they can't lend. The CD ratio is around 70%. In the case of private sector banks, whether corporate facing or non-corporate facing, you have the CD ratio approaching 90%. They can lend, but they are scrambling for deposits, and the cost of funds are actually going to go up. But in an environment where credit is growing at 15%, deposit is growing at 10%, it still makes sense to own the private sector banks because they are still making money. Their growth is going to be coming at the expense of PSU banks, and markets would tend to extrapolate next many years of growth, or maybe let's say next 2 to 3 years of growth in the stock price, as opposed to state-owned banks. Because of want of capital, most of the growth is basically going to come from provision write-backs, and the whole point is that there is going to be growth, but is there going to be EPS growth in the case of state-owned banks? Primarily because the dilution will take care of the fact that your EPS might not grow commensurate to the growth in profits for state-owned banks, and that makes the whole exercise that much more challenging in buying state-owned banks. Of course, State Bank of India would be an outlier, and if one was to own any state-owned bank, it could be just State Bank of India, nothing else. But in the financial space, which is roughly around 35 to 40% of the market, the banks are going to be advantageous, and makes sense to buy banks over NBFCs, which are going to face pressures on valuations, pressures on growth, because cost of funds are actually going to go up, and the risk environment is going to be conducive for banks as opposed to NBFCs in the run-up to the IL&FS crisis, the trust deficit in the financial system, and so on and so forth. So that's how we are approaching. We are overweight private sector banks, which will lead the mantle for growth in the case of financials, ignoring state-owned banks till there is clarity on infusion of capital and how the growth and the EPS for each of these state-owned banks might play out, and ignoring the NBFCs or truncating NBFC allocation to the extent possible.
Manish, want to get your call on Bharti as well. Do you think it's a long shot at the moment? There is some activity building up there. They're fighting back. Would you go so far as to looking at that stock as an investment right now?
I don't think so. I mean, both Idea, Bharti, having a tough time given the amount of capital raising that they are doing. And Reliance, on the other hand, with 400 million subscribers and predatory pricing, is going to make life difficult for each of these two guys. I mean, from a 13-player industry, we are left with roughly a 3-player industry, and even though the EBITDA numbers for Bharti and Idea continue to be good, I think the capex requirements going forward will mean that either there is no free cash flow or it's just a case of survival per se. And 2 to 3 years down the line, there will again be a requirement for capital infusion. So again, the conundrum that your EPS growth is not going to be there. Even if you see, let's say, growth in absolute profit numbers, given the extent of dilution, your earning per share growth is going to be anemic. So give it a pass, basically. And if one was to take a call, it was, going all out on, Reliance per se. Well, this can be the biggest wealth creator, if he gets his whole strategy of TMT, converging media, telecom and technology together and merging that with e-commerce, as well as, somewhere down the line, even financing that commerce. I mean, that's a very good strategy, and if he is able to eliminate competition along the way, then of course there's enough money to be made in Reliance. So if one was to bet on telecom, it would be Reliance, not the other two.
Go with the leader, and why not Reliance Industries? The numbers also awaited on Thursday. But Manish, great chatting with you as always. Thanks so much for taking the time out.